Alright. So far we started with the use of various blockchain, went through NFTs and Web3. So today we'll be trading coins and trading NFTs. So this will be the last class for this month for further to the next month. So actually seeing trading NFTs when we discuss NFTs, so we'll just be moving on to trading aspect today, an introduction into trading to prepare us for next month class. So we'll be having our financial analysis and technical analysis. All right. So trading. What is trading? Crypto trading is the act of buying and selling. It's the act of buying low and selling high. That's crypto trading. Act of buying low and selling high. Like unlike investing, which means holding Bitcoin for a long run, trading deals with you trying to predict the movement of a particular assets. Now studying the industry as a whole and the price graph in particular. So you predict the price movements within a short period of time. That's what we call trading. So it's all based on speculation, right? Okay, so now there are two main methods people use to analyze crypto price. Now we have the fundamental analysis and technical analysis. These are the two major ways in which we analyze price before we place a trade. So we check the fundamental analysis and also check the technical analysis. We have an intro of what fundamental analysis is all about and also technical analysis. But we'll be going deeper from our next class, which we'll be holding next month in March. So successful trading requires a lot of time, money, and efforts before you can actually get good at it. So trading is not something you just wake up overnight and you're good at. It actually takes a whole lot of time, takes money and effort to get good at trading. And we said we have two methods in which we use in analyzing crypto prices, not just crypto itself, but other financial markets. So they follow these two basic methods, which is fundamental analysis and technical analysis. So proceed further with in order to trade cryptos, you need to do the following. So what are the following things you need to do before you can trade? First one, you need to have an account with a cryptocurrency exchange. We have various examples here. We have Luno, we have Binance, we have Bitmart, we have KuCoin and the likes. So you first need to open an account with the cryptocurrency exchange because that is where you can trade successfully. Second thing you need to do is to verify your identity. Now each of these exchanges they have what we call KYC, know your customer. So you need to be verified. So we have various level of verification. It can be level one, level two, level three. So for each level, some kind of information are required. For level one, it might just be your basic information, your name, your email address, and the like. But when it comes to the level two, they'll be asking you to provide the means of identification. So you need to pass through all the stages, and once you are verified, then you can go ahead to deposit fund into that account for trading. So you deposit your money to your account, and the fourth thing to do is to open your first position on the exchange. That is, you buy or you sell. But majorly before you start trading on cryptocurrency, the first thing you do is buying. Then after buying, the next thing you do is selling. Hope we get that. So except if you are trading what we call futures trading, that is when you sell and you buy. But that is another lesson for another day. So the fifth thing is so that's trading in a nutshell. So that's trading in a nutshell. So as we dive more, we'll be seeing various aspects of trading and types of trading. So anyone who does the above mentioned is called a trader. So if you do any of these things, you are called a trader. And platform where trades are performed, we have various platform where trades are performed. We have broker, we have exchange, we have P2P. So if you are doing any of this activity, either with a broker or an exchange or as P2P, that's peer to peer, then you are a trader. So move on to investing versus trading. Investing versus trading. Now what is investing? What's investing? So when people invest in crypto, it usually means they are buying these coins or token for a long term. And in other words, they believe that the price will ultimately rise regardless of the ups and downs that occur along the way. Usually, people invest in crypto because they believe in the technology, ideology, or team behind the currency, and this is what we call FA. And FA is an acronym for a word fundamental analysis. It's an acronym for a word fundamental analysis. So people who invest in cryptocurrency or in any financial markets, they mostly go with fundamental analysis when they're investing. They check the technology behind the product or the digital assets, check the ideology, that is what it has to offer, what problem is it solving, and they also check the team behind the currency if they are well known and if they will be serious with what they are offering. So when we go into FA from next month, we'll go deeper into all of this information and all of this detail and see what it entails for it to do a fundamental analysis about the particular cryptocurrency. What are those things you should look for? What are those information you should watch out for? So in our next class, where we'll be having fundamental analysis, we'll go deeper into all of this information. Crypto investors tend to hold the currency for a long run. And hold, HODL, is a misspelled form of hold, HOLD. So it was a popular term in the Bitcoin community that was born out of a typo of the word "old." And so this word is as old as 2013. So from there we have been using this slang in cryptocurrency. We say old means you should keep your cryptocurrency, do not sell it. That's the word we use for investment, for investing in cryptocurrency. But trading is a different ball game entirely. Trading is a different ball game. You need to understand the difference between these two in order for you to proceed in the crypto industry. You need to know what kind of style do you want. Do you just want to invest or you want to trade? You need to understand these two terms. Now, crypto traders, on the other hand, they buy and sell in short term. Whenever they think of a profit, whenever they think a profit can be made. So, traders don't hold cryptocurrency like investors. What they do is they enter a trade, they execute the trade, they have a buy target and they have a selling target. So they go in and come out, they go in and come out within a short period of time. Whenever you think of profits, when you think okay, this profit can be made, okay, now this market is looking good. This is an opportunity to enter. They find entry and they find exits. So you don't hold for long. They don't highest amount of time they hold maybe just 1 day or 1 week or 3 days or a month. So they don't hold like investors do that. They can hold for about a year, 2 years, 3 years, and the like. Now, unlike investors, traders can view crypto as an instrument for making profits. Sometimes they don't even bother to study the technology or ideology behind the product. Sometimes, but um, obviously they have to that they are the product they are trading. They use tools like charts, price action to predict movements within a particular time frame, and that's what we call TA for short. And the acronym for TA is the full meaning of TA is technical analysis. We said FA is fundamental analysis, while TA is technical analysis. So trader majorly make use of technical analysis. So this would give them an idea of what to buy and what to sell. At what point in time should they buy? At what point in time should they sell? At what point in time should they just observe and watch what is happening in the market? Which direction is the market going to? These are what technical analysis entails. So we'll be having a full class on FA and TA. So before then, you can also make research on your own and see what it entails. And if you have any question, you can always ask on the group. Crypto is very volatile. Crypto is very volatile. Crypto is very volatile. In other words, someone tried to get in. Okay. So now crypto is very volatile. In other words, you can make a nice profit if you manage to correctly anticipate the market. Unlike traditional markets, Bitcoin trading is open 24/7. That's one major advantage cryptocurrency have over other traditional markets like your stock, your foreign exchange, and the likes. Crypto market is open 24/7 and it's very, very volatile due to the fact that currently it's unregulated. You can have 100% up in crypto today, and the next minute you have 100% down. That's how very volatile it is. Very, very volatile. So, this advantage of volatility makes traders to make money in a short period of time. They just keep accumulating and compounding that profit till they have something tangible, and some of them becomes investor in the long run, because trading actually involves you going in and coming out of the market, strict monitoring, having to do all of these works. So crypto is very volatile. We already know that it's very volatile. So if you want to trade, you need to move along with the volatility. You need to move along with the volatility. And you need to have some tools to help you know when to get in and when to get out. Let's move forward from trading. So we've discussed trade investing versus trading. So now we are moving forward with trading types. So we have various types of trading. I have four types of trading. According to my list, we have scalping, we have day trading, we have swing trading, we have position trading. We have scalping, we have day trading, we have swing trading, and we have position trading. Now, if you practice any of these trades, you are called by the name of the trade you practice. Called by the name of the trade you practice. So now, if you are practicing scalping as a trade, you are called a scalper. If you are practicing or using the style of day trading, you are called a day trader. If you are swing trading, you are called a swing trader. And if you do position trading, you are called a positional trader. So the trading types determines the kind of trader you become. So it depends on your kind of personality and what works best for you, that determines what kind of trading style you adopt or imbibe. So now for scalping, you tend to make substantial profits on small price changes, and it's often referred to as picking up pennies in front of a stream ruler. Now scalping focuses on extreme short-term trading, and it's based on the idea that makes small profit repeatedly over a period of time. So with scalping, you make little profits over a short period of time, and you keep on repeating that process over and over and over and over again. So if as a scalper, you can make a dozen trade, you can even make up to 100 trade a day. That's for scalping. So scalping, they go in like within minutes. They get in and out within minutes. You can see them go into market maybe 5 minutes, 10 minutes, at max 30 minutes. But trade trading involves conducting multiple trades throughout the day and taking profit from short-term price movements. So the day trader, they spend a lot of time staring at the computer, especially scalpers also spend a lot of time staring at the computer, and they usually close their trade at the end of each day. So day trading does not exist that day. So all your trading will be in between um, the 24 hours range. That's for day trading. 24 hours range for day trading. But scalping has to do with, let's say, a minute, 5 minutes, at max 30 to 45 minutes for scalping. Some go as high as 1 hour for scalping. So, but for day trading, it takes a period of 24 hours each day. Each day you go into the market 24 hours. So now we move on to swing trading, which has to do with a type of trade that takes advantage of normal swing of price cycle, because the market is always in cycle, and we have two type of trend in the market. We have about three type of trends. We have the upward trend, we have the downward trend, and we have the consolidation trend as the ranging trend. So swing traders try to spot the beginning of a specific price movement and they enter the trade. and they hold until that movement dies out, and they take their profit. So swing traders, they are more like taking a position at at the beginning of the trend, and they exit when they see the trend is trying to change pattern, either from a upward movement is trying to break, they want to change the pattern towards the downward movement, so they exit the market, or they start from the top and they exit at the bottom, depending on the kind of trade they are placing, either a buying trade or a selling trade. And this trade can go on for this position of this trade can be open for about a week, and sometimes um months months. So it span within weeks or months, so it doesn't exceed a month for swing trade. But when it comes to position trading, it also takes the style of swing trading, but now it spans longer than swing trading. It can take about 3 months, 6 months for for position trading. So we call those people positional trader. So they actually hold their trade for a very long period of time before they exit the market. So let's proceed further. So we are moving on from types, trading types, and moving on to trading method. So you see, we keep meeting fundamental analysis and technical analysis, because that's the art of trading. That's the art of trading. You need to master any of these. If you want to use fundamental analysis, fine. If you want to use technical analysis, but for traders, you need technical analysis. You need to meet someone who is an expert in technical analysis to tutor you and guide you through the trading process. Then there are two ways to trade as a trader. You must know how to use both in order to be successful on the long run of trading. Now, mind you, any of the two is better, but the combination of both is best. So when you combine these two methods, it actually works best for you. You can combine both of them, fine. If you can use just one, fine. Whatever suits your taste and works for you better. As far as you make money, that's the major aim. The goal and objective of trading or investing is for you to make money. So whatever method you are using and is bringing in income, profits, making money for you, fine, go with it. So analysis method, we have two, which is the fundamental analysis and the technical analysis. Now, fundamental analysis says it tries to predict the price by looking at the big picture. So fundamental analysis takes a holistic view, looking at the bigger picture of a digital asset. Now, in Bitcoin, for example, say fundamental analysis evaluate Bitcoin industry, talks about the news about the currency, the technical developments regarding that particular um asset you are trading, either be it Bitcoin. So for Bitcoin, we have technical improvement or development like Lightning Network that is improving the transfer fee or transfer transaction time for Bitcoin. So when you transfer Bitcoin, it delivers at the speed of light. So within seconds, it gets to its destination. So these are kind of technical developments. We also have regulations around the world which affects price either positively or negatively, and any other news or issues that can affect the success of Bitcoin. And this methodology looks at Bitcoin value as a technology regardless of the current price, and it's relevant outside force. So this is fundamental analysis. So but this is just like a brief of what fundamental analysis entails. This is just like a brief. We'll have a class separately where we talk about fundamental analysis in detail. So say in order to determine what happen in price, so we use fundamental analysis. Say for example, if China suddenly decide to ban Bitcoin, this analysis will predict a probable drop in price, then followed by an increase in price once traders see buying opportunity. So this can be seen as a fundamental analysis towards buying and selling of Bitcoin. So move next to technical analysis. I will say technical analysis tries to predict the price by studying market statistics such as past price movement to chart patterns and trade volumes and many more. It tries to identify patterns and trend in the price. Based on this, based on this deduced what will happen to the price in future. So now technical analysis is more like, let me put it, so it's more, someone saying something. Mr. Michael, do you want to say something? All right, let me mute you. Sorry for that break. So now when you talk about technical analysis, it's more of a point and kill approach where you see what is happening currently, you execute it, and once you meet your targets, you leave. And even though you don't meet your targets, you still have a fail safe or something to take you away when the market is going against your bias or your speculation. So that's technical analysis for you. So it tries to identify patterns of trend in price based on this deduce what will happen to the price in the future. And the core assumption behind technical analysis is this: regardless of what's currently happening in the world, price movement speaks for themselves and tells some sort of story that helps you predict what will happen next. So most times, see, there's always a fight between technical analysis and fundamental analysis. Even up to this week, currently where we are in, we still argue it in one of my crypto I belong to. So technical analysis, fundamental analysis, they are interwoven. You need both of them to survive this crypto industry because there are sometimes technical analysis might not play out the way you want. You need fundamental analysis. There are sometimes fundamental analysis will not play out the way you want. You need technical analysis to actually know what you are doing and um what to leave and what to hold. All right, because the technical analysis might be saying something else. Technical fundamental analysis might be saying something, and technical analysis might be saying the opposite. So you need both of them in order for it to survive um in this space. So move further to some trading terms mostly used. So we have some terms we use in trading, like we have the platform, which is trading platform versus broker versus P2P. Now for trading platform, it's just like your general exchange where you buy and sell cryptocurrencies where you trade. But for brokers, these are platform where they sell the coin directly to your wallet at a very high fee. So call them broker. So there you're not allowed to like trade one crypto for another. You just buy directly with your fiat currency or your credit card. Those are who we call brokers. Buy for P2P, which is peer-to-peer platform, is where you execute buying on selling of crypto assets with them directly, person to person. So you just have the exchange just to help you facilitate the trade. But the trade is actually happening between you and the person in charge. So either you are buying or selling on that platform. So you need to know the difference between these three platform. Trading platform, which is also an exchange. We have brokers and we have P2P platform. Now the next for the trading terms is order book. So the next picture I'll be explaining order book. So now with this image, you will see by my left here, you see we have Bitcoin. This is a like an interface, a trading interface for Bitcoin, and it's paired against USDT as a stable coin. So here you see various price of Bitcoin at different amounts and the total amount people are willing to buy Bitcoin with. So this is what we call order book. So it shows you the buy and the sell side. So the one you see in red is the buy, sorry, is the sell, and it's called axe. It's called axe side. While the green side you see at the bottom is called the bid, which is the buying side. This is the amount people are willing to pay for one Bitcoin. While this top side is the amount people are willing to sell a Bitcoin. So you see they have different prices and amounts because these are an exchange. So what they do is they aggregate. Now if everybody is if we have 10 people buying at a particular price, they aggregate everything and place it on the order book so that if you want to buy you can either easily buy from the first price. If you are buying, you buy from this seller, but if you are selling, you sell to this buyer. So that's how it works basically. As I also call that the order book. Call this order book. It displays. So what order book does is just for you to display the price of those people buying and those people selling. So it gives you like an idea of how many amount of people buying currently and amount of people selling currently. So that's order book. So we have market price, which talks about the current price of a particular asset. So currently now, Bitcoin might be around $35,000. So that's the current price. That's the market price of Bitcoin. So for this chart here, Bitcoin, the current price of Bitcoin, the market price of Bitcoin is around $7,791,000. So that's the market price. That's the price at which Bitcoin is sitting at currently. That's what we call market price. So we have highs and low. When you talk of high and low, you're talking of um the price movement in a period of 24 hours. So I talks about the highest point a price gets to in a period of 25 hours, while low talks about the lowest point price gets to also in a period of 24 hours. So let's see the chart and let's determine high and low. So now for this chart, we have high and we have low. Now you see at the bottom here, we're having this. At the bottom here, you're having $7,476 as the low for 24 hours. This why this is 7,792,000 dollars. So now this is low and why this is high. So for this chart, this is a 1 hour chart. So from this point to this point, you can see the low and see the high. So Bitcoin went as low as this price in a period of 24 hours, while it came as high as this in a period of 24 hours. So these are kind of terms you need to be familiar with when you want to trade. When you are trading, these are terms you need to be familiar with. So we have talk about high and low. We have volume. Okay, so for this chart, we'll be using this chart to describe all of these things. So what you see here is volume. Now, volume is talking about um how much of money is in the market currently and people buying. Now, if people are buying, you'll be seeing an increase in this volume. If people are buying, like you have so many people buying, the volume will increase, or you have so many people selling, the volume will also decrease to the downside, and you have them like that. So these are volume. So volume plays out when they have much people buying or much people selling. You actually see like a reflection in the market. You know when people are buying more, what happens to the price? It tends to go up. When people are selling, when more people are selling, the price tends to go down. So that's volume for you. Volume. All right. So the next on our list we have market order, or we call it instant order. So just like we have market price, market order also works. So if you look at this bottom, if you look below here, you're seeing something like an interface of buying and selling. So this is like where you execute your trade on an exchange. So when you open your exchange and you want to buy, you want to sell, you look for something like this. So here allows you to buy, while this other part to sell allows you to sell. So for this buying side, now if you want to buy immediately, that's what we use the market. We use the market order. If you look here, you see what we have market. So when you click on market to buy at the current price, yeah. So it's buy at the current price. Now there are sometimes maybe you want to buy up to 1 Bitcoin, but the current price of Bitcoin, the current person selling in the market is not selling up to 1 Bitcoin. So what the exchange does for you is to help you aggregate from that lowest price to the highest price of not like the highest price, but like to just aggregate everyone fund and accumulates up to 1 Bitcoin and sells for you at an average price. So that's market price. Or when you're selling, the same thing happens with selling. It also aggregates everyone buying at that moment and gives you your equivalent. But if you have someone who is matching your order immediately, it gets filled. Or you're having an order that is more than what you are requesting for, you just take out of it and you leave. So that's why we said cryptocurrency market is kind of a liquid market, very liquid because you can sell instantly and buy instantly. So we have limit order. So limit order is like the opposite of market order. So instead of you buying instantly, limit order will actually wait until the price comes to meet you and there's someone to take that order from you. Either you're buying or you're selling. So limit order, you spot an entry of buying, you enter at that price, and the order will be pending until the price bends towards that direction, either to the upside or to the downside. If you are buying, it has to come up to meet your price. If you are selling, if you are buying, depends on the point at which you are buying. Now, if you are buying now, when the market is at the top and you're buying, that means you have to come down to meet your price. When we are selling, you bought at the bottom, you want it to come up and meet your price to sell at that particular price. You know, we said trading is the act of you buying low and selling high. That's the basic rule of trading. You buy low and you sell high. You don't do otherwise. Because when you do otherwise, you make loss. So in trading, you buy low and you sell high. You should note that if you don't learn anything today, note that trading involves you buying low and selling high. So alright, so limit order, like I said, is the opposite of market order. Your order will not be filled instantly. You have to wait until it gets to your turn, just like taking a queue on an ATM stand. Alright, so now we have stop loss order. Now, stop loss order helps you to mitigate loss to take you out of the market when it's going against you. And let's say you bought Bitcoin at this top, at this high of $7,792. You bought it at this top, and all of a sudden it started going down. It didn't go your way. Now you place your stop loss at this low, 7,476,000. All right. So now it will you be once it gets to this your stop loss, it will execute a market order for you, and you will um leave it will execute a market order for you, and your trade will be out of the market. So you've just taken a little loss of about if you subtract this from this, you should be having about, let's say, around $300 loss, compared to when it goes down to as low as $5,000 without a stop loss. So you know you've lost about close to $2,000. So that's what stop loss does for you. It helps you to reduce your risks and your loss in the market. So now we have the last one here, which is maker and taker fee. Maker and taker fee. And what for every exchanges, there's something they call trading fee. So maker and taker fee is trading fee. Now when you are buying in a market, now you can either be a maker or a taker. Now being a maker means you are placing a limit order. And when you place a limit order, you know I've explained limit order. When you place a limit order means you are making the market, that means you are placing a price at which you want to buy at or sell at. So you are waiting for someone to come and take that order from you. So if you place a market order, you are a taker. And for each of these activity or operation you perform, there is a fee attached to it. There's a fee. These exchanges you pay when you make any of these transactions. So there's a fee attracted to it, and this fee is what they accumulate from all of their users to run their day-to-day operation on their exchanges. Now, you can pay as low as, let's say, if you are to convert it from dollars to naira, you can pay as low as 5 naira per trade. So imagine we have 1 million people executing buying and selling on that exchange, and they are paying 5 naira per trade. Now multiply 5 times 1 million people. That's about 5 million naira in that day. So you can see these exchanges, they're actually making money from that, and that's how they are able to scale up their platform, add more features, do promotions so that more users can come on board. That's how they pay their staff, their developers, and the like. So that's where they make their money from. So they don't really make money from you trading on the exchange, because what they just do is provide a platform where someone else in another part of the world can come and buy or sell. So they like bring everybody together in a central location where they can do this transaction trustlessly. So you don't need to trust the other person before you place your trade. All you just need to do is trust the exchange providing you that platform. So in order for them to keep facilitating that trade, they charge you a fee, which is either called the maker and taker fee, and this percentage is quite very low. That's why I said when you convert it from dollar to naira, it can be as low as 5 naira. So they do once so what they want is numbers, because they know once their platform is kind of popular and people trust them, then they know more users come on board, and from there they generate revenue from that means. So you just need to be aware of this so you know okay how all these things work. All right, so we've seen, like, we've had an idea of all this of what is happening here. So we have the charts. There's the charts. Can we call it candlesticks? Call it candlesticks. Below we have the place where you execute your trade, and beside it, by your right, you have trading pairs. You have different coins you can trade BTC with, and we have trade history. That is various transactions that has happened currently. So this is just like an overview of what a trading exchange look like, trading interface. So if you look at the top, you see the name of the coin, BTC USDT. You see the last price it was traded at, but now the change in 24 hours, how many percent change? It has done about $40 percent change, which is plus 0.53%. We have 24 hours high, we have the 24 hours low, and we have the volume. Volume talks about the amount of money that has been involved in buying and selling in a period of 24 hours. So that's on that. So proceeding further with reading price charts. Reading price charts. So reading price charts. So now that you are familiar with the trading terms, it's time for a short intro into the price graph. Now, majorly we use the Japanese candlestick. That's what we use majorly in technical analysis to determine the price movement, because each candlestick has a particular meaning. And for you to trade, to be a very good trader, you need to understand each of these candlestick one after the other. You need to understand it one after the other. Right? You need to understand all of these candlestick one after the other. Now, a very widely used type of graph is the Japanese candlestick, and is based on an ancient Japanese method of technical analysis, and it has been used in trading rice since 1960s. So candlestick was brought up by a Japanese and dates back as far as the sixth, sorry, this the 60s, 16s, sorry, 16s. So it dates back as far as 16s, and each of these candlestick have a particular meaning, and they have what we call opening. They have their lowest point, they have their highest point, and they also have their closing price of any given period. Now, due to that, we can call it a OHLC graph, which means open, high, low, and close. So OHLC graph can be means open, it means high, low, and close. So I'm going to show us an example of candlestick. So this is how your candlesticks look like. This is how it looks like. So it has just basically two color, that's green and red. You can actually change the color if you want to on your trading app. You can change the color to whatever color you wish to. So um the green part, which indicates that the price is going up, and we have the red part which indicates the price is going down. So it's actually indicates which point the price is heading to. So that's what it does for you. All right. Sorry for that noise. I'm trying to leave that location. All right. So let's continue. So that is um that is that about that on candlestick. So for candlestick, we have some parts of the candlestick. So we have the open, which for the opening price, that's for the green parts. We have the open at the bottom, while the close at the top. So this candlestick indicates that the price is actually going up. So that's why we have the open at the bottom, while the close at the top. So candlesticks, depending on the time frame. So we have various time frame. We have 1 minute time frame. We have 5 minute time frame. We have 30 minute time frame. We have 1 hour time frame. We have 4 hours. We have 12 hours. We have 24 hours, which is one day. We have 1 week. We have 1 month. So if you are working on a 1 hour time frame, that means this candlestick will be formed within 1 hour. So it will tell you the price movement within 1 hour. If you are working with 1 minute to form within 1 minute, you are working with 1 hour one day. Candlestick will form within one day, indicating the price movement for that day, either to the upside or to the downside. So for opening price, which indicate the price going up, we have the open at the bottom, the close at the top. So this stick you are seeing outside this rectangular bar is what we call the wick, and the wick is always the same. So the top is the highest price, while the bottom is the lowest price. So for the selling candle, which is the red candle, the buying candle is the green one, while the selling candle is the red one. So we have the open at the top, while the close is at the bottom. So you know where it's selling, it's coming from top to bottom, coming from up to down. That's why we have the open at the top, while it's close at the bottom. So also this candle is formed within a time frame. Now if you are using a 1 hour time frame, this candle will be formed, and whatever um style or size of candle you see determines what is happening in the market currently. So that's candlestick for you. So we have more to candlestick than it is just like an intro to what candlestick is. So now we have the bull and the bear market. We have the bull and the bear market. Now just like the name of the animals, bull, it shows when it's attacking, it's actually thrusts its on up in the air. That's what we call the market that is actually going up, showing a green candlestick. Call that a bull market. But when the market turn upside and is going downwards, it's form we call it a bear, because the attacking force of a bear is poor, and is always going towards a downward direction. So that's why we named both both movements after these animals. The bull shows the market is in green, is going up, everybody is happy. But the bear shows everyone is kind of sad itself, because psychologically speaking, human beings always want something to go up. So when it's green, that's when you see euphoria in the air. Everybody is happy. Oh, we're making money. But when it start coming down, people are also making money. But then some people are also making loss majorly. So these animals are metaphor for the movements of the markets. So if the trend is up, it's a bull market. But if the trend is down, it's called a bear market. Now we have what we call the resistance and support level. Is a very key area you need to note. Actually, you might not get it at this first instance or this first glance, but with time and practice and um, consistency, you get to understand what the resistance and the support level is all about. So now there's a picture dissipating resistance and support level. Now you see, take support as floor, while resistance as the roof. Support as floor, resistance as. Now when you say floor, means like the base. A building is supported at the floor, right? And when you want to cover the building, you put a roof on top of it to cover the building. So now look at this image here. See this image. It says support and resistance. So you can see the base of this candlestick is what we call the support. So support is like a resting place for a candlestick, and what we can call a place of support, that means various at various intervals or at various points in time, it must come the price must have touched a particular level over and over again. So if you see this this support zone here, you can see that the price touched this level. So whatever is the price here, the price movement came here four times, came one, two, three, four. So here we can call this a support level. So now there is always a fight between the support and the resistance. Always a fight between support and resistance. Now when the support and resistance is happening, there's something that follows. We have either breakout or breakdown. We have a breakout either to the upside or to the downside. For this, we have a breakout to the upside. So you can see after a while it went outside the roof, which was our resistance. So resistance is like a point that is resisting the price from going further. We also have what we call fake breakout. If you see at this top here, it look as if it's breaking out fully, but it came down. So we call that a fake breakout. Couldn't continue. There was no buying power to actually push the price further. So sellers took over and went back to the support zone. So majorly in trading, there is always this repetition in history where price will always go back to a previous support. So that's what trader is majorly in trading. So they say, okay, this price has actually come to this support zone. There's definitely it will make the new resistance. So from that resistance, it's okay. It's possibly for it to go back to that support zone before going further. So if it breaks this support zone, then that means it's going towards the downward direction. Then to look for another support zone before it can hold, just like the way we say it in trading. So trading actually involves some terminologies we need to be familiar with. So resistance is like a resisting point where the price is actually trying to fight through to leave. So but since it's not leaving, it's called the resistance. So you see it came towards the support zone, went up. There was a resistance between the buyers and the sellers. It went back to the support, came back up, went down, came back up, went down, came back up, went down, but didn't get to the support before it actually broke out. So that's resistance and support. We also have another image here. So you can also see same thing happens here. We have the support at the bottom, resistance at the top. Now there's also something we need to note that sometimes support turn resistance and resistance turn support. So what do I mean by that? Like this support zone now is a support zone now. When the price broke through this resistance, this point became a support, a new support. So you can see after it broke through this resistance zone, it became a new support. Becomes a new support. But if it goes down, this support will now become a resistance zone. So the price might find difficult to break this below going upward. So I know some of these things might be looking strange and new to us, but don't worry, just take your time. You actually understand them. Time, everything will look clearer. So that's one of the major aspects we use in trading, support and resistance. Very, very important. Very, very important. You need to take note of this. You can also watch some videos online on YouTube and see further explanation on support and resistance. Just purely support and resistance, nothing else. Just watch and learn other stuff on it. All right. So now we are going to be wrapping up with the common trading mistakes. So the class has been on so far. All right, so now let's go over the most common mistakes that people make when they start trading. Now, in hope for them to be able to avoid them, so we need to let you know of all these mistakes. The first mistake is risking more than you can afford to lose. And there's something we call risk to reward ratio, RR, risk to reward ratio. Now, are you risking 1% to achieve 2%? Are you risking 2% to achieve 1%? That's a very bad one. You can't risk 2% and achieve 1%. Therefore, you to risk 1% to achieve 2%. That's a very good risk to reward ratio. Don't risk $100 to make $50. That's a very bad style of trading because you just lost $50. But when you reach $100 to make $200 or even make back the $100, it's still okay. That's what we call 1 to 1 reward ratio. Or you reach $100 in order for it to make $1,000, 5,000 or $500. That's risk to reward ratio. So you shouldn't risk more than what you can afford to lose. If you know, okay, this I have just $100 for trading, don't go all in with the $100. If you know when you lose that money, you go back to to ground zero and you feel pain like you just lost the whole all of your lifetime saving. You don't engage with it in a single trade. That's why I said you should have a capital allocation. I remember in our risk assessment class, we talk about capital allocation. That should be our third or second class. We talked about capital allocation. That for trading, you allocate about 30% of your trading of your total portfolio, why 70% for investments. That out of that 30%, you still don't go all in with that 30%. You allocate some certain amount for trading. And let's say, for example, you have $1,000 to trade or to invest in cryptocurrency, as the case may be. So now 30% of $1,000 is $300, right? Now, if you want to trade, you shouldn't go all in with that $300. You can as well still split that $300 into um fraction. You can have it into 6 places, so you have $50 per trade, or you can say $25 per trade, or you can say $100 per trade. So if you know you're having $100 per trade, that means you are entitled to having just three trades. But if it's $50, you can have at least as six, you can have as far as six trades. So you just need to allocate your capital rightly, so you don't risk more than what you can afford to lose. Now, the second thing you need to do, second mistake people make is not having a plan. Before you go into trading, you need to have plans of your trading. You need to plan your trading. Okay, what are those conditions the market must do before I enter this trade? Call it having a plan. Call it kind of strategy. Stick to your plan because we know human being can be greedy at times, and we you just this is an opportunity, let me buy. You leave your trade and all of a sudden you lose your money. So when you stick to your plan, it helps you win at the long run. Makes you a better trader. It makes you a disciplined trader. So you should have a plan. Don't make the mistake of not having a plan. The third one is leaving money on an exchange now, because most of these centralized exchange are prone to attacks from greedy parties and different kind of people. So you shouldn't leave your money on exchange when you've made a trade and you made some substantial kind of profits. It's advisable you move that money from your exchange to your decentralized wallet where it's more safer. Fourth mistake make is giving into greed or fear. Now greed or fear happens when there is a news and all of a sudden the the market keeps booming up and Bitcoin keeps moving from $1,000 to $2,000. All of a sudden, it's at $10,000. From that $10,000, it's already moving to $50,000. And you're afraid that will this thing never come down again? Will it ever come down again? Then at that moment, you are fearing, you are afraid. There's something we call FOMO in crypto. These are some kind of terms. I didn't include it in this guide, but I will share it with us on the group for us to just go through it. Don't make it lengthy. So it's called FOMO. It's called fear of missing out. You're afraid of missing out of the trend of the rally, and you say, let me buy now, let me buy now. That's why I started seeing people asking you, should I buy this now? Should I buy that now? When there's you feel when everybody's talking about it and the market is going towards the direction they are talking about it on, and you feel like this is the right time for me to buy. You're afraid if I don't buy now, I might miss out forever. Then you give into that fear, you buy, and after buying, after some hours, it goes the opposite direction and you begin to blame yourself. Or you've entered the market quite alright and you made some profit, but you still say, no, let me still wait, let me still make more, let me make more. That is greed. That's greed. And what happens? All of a sudden, the market takes back what it has given you. So these are mistakes we make, and I'm bringing it to you now not to make same mistake, but some of these mistakes are inevitable because human factor will surely come in. So you just need to know how to control your emotion, because trading is more of an emotion kind of game, emotional kind of trading, psychology kind of um, game that plays on you, and now left for you to know how to play the game well. And the fifth mistake, not learning on the less, means not learning the lesson. Sorry, the lesson. It's supposed to be lesson, not lesson. Mistake. So not learning the lesson, like mistakes you made in the past, you're not learning from it to improve yourself, is the kind of mistake we should avoid. So when you make a kind of mistake or a trade, you always learn from it to improve future results. You always learn from it to improve future results, because one thing you need to know about any financial market is not controlled by you and I. It's controlled by the big banks, institutions, market makers, those people that have large amount of funds. So you are playing against these smart people. And how do you outsmart them? You can't outsmart them. You just need to have an high sources of high success rate. Yeah, you just need to have high success rate and learn from your mistakes. Your mistakes will actually help you improve you and become a better version of yourself. Like they say, practice make perfect. So when you try it today, you fail, you keep trying. So many of us have lost a lot of fun trading, and we didn't stop, we didn't quit. We keep trading, and we note down our mistakes and we tend not to repeat them. When we encounter new mistakes, we note them down and we keep forging ahead. So just want to advise you and encourage you, because trading, if someone will tell you you won't lose, is a lie. You surely lose in trading. It's not left for you to know how to mitigate your loss. That's why learning and acquiring the knowledge is very, very important before you go into trading or doing any other thing. So this is what we'll call it a day for today. Um okay, this I'll be launching a guide very soon. So this is 27th of February, early March. That's the first week in March. The guide should be out. We're posting information on how to get the guide. And the goal of this guide is to make the whole crypto journey very easy to learn. So it makes learning and earning very easy. Now, why you should get the guide? To increase in value. From the initial stage, the price will increase after some time. You get access to mentorship, access to private community and events. You also get NFT access and membership pass. Now the NFT that will be minted on this course is just 1,000 mint. So when the course have sold, the guide have sold about 1,000, it won't be in circulation. It won't be for sale again. The only place where you can have access to it is on the marketplace, NFT marketplace. If anybody wants to buy the course, you have to go and buy it from NFT marketplace. So if you buy the course, you'll be having access to the NFT. And also affiliate commission. We also roll out affiliate commission on the long run, and also many other benefits to come. So at the end of this training, everybody gets an NFT as proof of participation. So at the end of the training, so the training will be ending next month, that's March. So we've passed through 2 months of training. So January is February, and now we are entering March. I want to thank every one of us for staying with me till this very moment, and also following through the classes. And I want to also hear from us if you've actually learned something or not. So thank you for attending to this class. I hope to see you in the next class. So this time for question and answer feedback from everybody. All right. Any question? All right. Thank you, boss Olabi. Thank you for always staying with me. Okay, you don't have question. You don't have question. Nobody's joining us. All right. Mr. Michael, Miss Deborah, do you have question for Call It a Day? Do you have a question? Please ask a question. Okay, you are good. All right. Thank you. Oh, Miss Debbie. Oh, okay. Do you have a question? Let us know if you have a question. Okay, you are good too. All right. So thank you for joining today's class and thank you for staying till this moment. So I'll be sharing this guide with us as well. So I'll post the link to the Medium post where we get the guide that we can read through. Wait for the video. Like I said, to be in the guide, I'll be launching out soon. So all the videos that we've missed, you can actually get them and have access to them in the guide. So for those that have been faithful to the class, you have this guide at a very, very discounted rate. Thereafter, we increase the price for our latecomers. All right, thank you very much. Have a lovely week. Do you want to say something, Mr. Buluwatife?
Well, I don't really have much to say, but I'm just glad to be part of this meeting. Though I came late, but I knew there is much more to learn from. So hopefully, in our upcoming message, meeting, I would ensure I'm on time there, so I will learn more.
All right, all right. Thank you very much. Okay,
Welcome,
so
sir.
I will share the guide with us so we can go over those things we said. And if you have any question, you can as well shoot it on the group and we provide answers to them. All right, so I want to wish us a lovely week ahead and have a great day. Goodbye, everyone. Good
Good,
night. Sleep well.
good night, sir.
All right, sir. Got me, sir.
Good night.
God bless you.
Amen. God bless
Mr. Bull, come to class early next time. I shared the link to you before now.
I'm sorry, sir. Thanks so much. I would ensure I come on time, sir.
you. All right,
All
no
right.
problem.
Yeah.
All right, good night.
Oga Michael,
Sir,
please that night, sir. Thanks
yes,
so
sir.
much. We really appreciate all you do.
Sleep well.
It's
Yeah.
not really easy. I know what you passed through to do the class.
Right now,
Well,
thank you.
I mean, okay, I appreciate the free thing. Everybody about the work, I appreciate it.
Emma worry. Very soon is getting paid, so
That's
just
our Nigerian mentality.
that's Nigerian mentality for you.
Thank you, sir.
All
All
right,
right. Good night.
good night.